Without question, the number one headline in the media today regarding finance is inflation. But how exactly is inflation defined? And what impact does it have on your portfolio? And more importantly, how can we protect against inflation? Hi, I'm Chad Butnary, Wealth Advisor with the Andrews Group at Asante Capital Management, and today we're talking inflation. We're currently experiencing inflation in real time. Every time we go to the grocery store or the gas pumps, it's pretty obvious that we're experiencing inflation in a number of different areas in our day-to-day life. But when inflation numbers get reported to us, how exactly is that being measured? Well, the Bank of Canada uses something called the CPI, or the Consumer Price Index. Although not a perfect measure, the goal here is to estimate the average shopping experience of Canadians and includes items such as food, shelter, transportation, clothing, etc. The Bank of Canada's stated goal is to keep inflation between 1% and 3% annually. Recently, this goal has not been met. The current year-over-year inflation rate as of the end of May was 7.7%. So, what implications does this have? The most obvious one from a consumer perspective is the erosion of purchasing power. It takes more money to buy less. This is challenging for everyone, but especially those on a fixed income or a budget. From a business perspective, employees may require additional compensation. This puts pressure on companies' bottom lines, i.e. profit, and can cause lower overall valuations. Is this what's happening in the stock market right now? Maybe. The next question is, what is the Bank of Canada's response to this inflation, and what impact does that have? The first tool that the Bank of Canada will use to tame inflation is raising interest rates. The idea here is that raising rates will cause companies and individuals to spend less, demand will decrease, supply will increase, and bring inflation back into equilibrium. There's much debate on whether this will actually work, how long it will take, and to what magnitude it needs to be done to be effective. In any case, this is the course that many central banks around the world are taking today. Okay, now that we have an idea of how this all works, let's talk about the impact to your portfolio. To examine this, we have to look at how rate increases affect stocks and bonds, as it's substantially different for each. Let's look at bonds first, as that's probably the easiest to understand. Further, let's break this down into short versus medium/long term. As interest rates go up, bond prices tend to decrease in the short term. There's a clear inverse relationship here. Why is that? Well, let's take an example. Let's say investor A owns a bond that he purchased 1 year ago that offered an interest rate of 2%. Now, investor B comes to the market today and wants to buy a bond with the same term. He can buy the bond from investor A if A wants to sell it, or he can buy a new bond on the market offering a 4% rate. Why would he buy the bond from investor A when it's paying 2% when he can go to the market and get one for 4%? The answer is investor A has to discount his bond or sell it at a lower price so that the return is roughly equal. This is why bond prices go down when interest rates go up. So if bond prices decrease in the short term, what happens in the medium or long term? In this case, when investor A holds his bond to maturity or sells it at a discount, he can now go to the market and buy a bond at a higher rate as well. When an investor owns a bond or a pool of bonds, each bond matures at a different date. As they mature, more of the money can be invested in bonds with higher yields, and therefore the returns of the fund start to go up. The shorter the term of the bonds in the pool, the more quickly this will happen. So in the medium term, investors are typically better off as rates go up. Now that we've examined bonds, how does a rising rate environment impact stock prices? This is a bit more complicated. It turns out in the short term, there's no real reliable relationship between stock prices and inflation. Sometimes stocks go down when inflation is rising, and sometimes they go up. So far in 2022, they've gone down. So what about the long term? In the long term, the evidence is clear that the best way to protect against inflation is to own stocks. In particular, small company value stocks have outperformed most significantly against inflation. To put some numbers to this, from 1927 to 2021 in the US, and in years in which inflation was higher than average, the overall equity market has outpaced inflation by about 5.1% annually. Not bad, but a small cap value portfolio would have outpaced inflation by 12.4% annually. That's quite a difference. Now that we've examined all of this, the question is, what do we do about inflation and rising rates? Is there a solution? The answer is yes, but it's not a one-size-fits-all, and it's not overly exciting. The best way to hedge against inflation is simply to own a portfolio of stocks and bonds, ideally tilted towards small value companies that allow enough growth to at least maintain, if not increase purchasing power over time, but still allow you to sleep at night. The sleepability factor is important, and that's different for everyone. If it weren't, most of our clients would own a 100% equity portfolio and likely experience higher returns over the long term, but it would be at the cost of extreme volatility in the short term. Risk is an important concept to understand, and it can be different for each individual. To some, risk is short-term volatility and not being able to sleep at night. To others, it might be not reaching their long-term financial goals or having enough in retirement. The ironic part about investing is, if you want to meet your long-term financial goals and combat inflation, it is actually much safer to own more stocks and experience more volatility today. In contrast, the safer you feel today, the more risk of not meeting those goals and inflation eroding your capital in the long run. So, what's most important to you? Would you rather meet your long-term financial goals or feel comfortable today? For most people, there's a balance, but it's not always possible to achieve both. I'm Chad Butnary with Sante Capital Management. Thank you for watching. If you or someone you care about has questions or concerns about this subject or any other, please visit our website or give us a call anytime. We're here to help.